Ladies and gentlemen, welcome to the 19th episode of the Futurum Equities podcast. You got myself, Shay Boloor. We got Danny Dimes over here. Wow, what a morning! What a week!
I had a friend tell me the other day. He said, you may be poor, but at least you're jacked." So,
at least you invest in some fixed assets by being jacked.
relative there. I mean, yesterday was pretty brutal. SoFi went all the way back down to where it was on Tuesday. I was stressed out about that because, all the way back to Tuesday. I was still up on the week, but I'm that isn't the case with everything. There's definitely some growth names that have been slaughtered week to date. Yeah. But it all depends, like I said, on the zoom out year to date. We have the righteous bears are out, slamming their chests right now, roaring very loudly, having some fun with the trolls. I've been picking up some of my trolls and yours, by the way, having great conversations with them here.
I have trolls. What? No,
I'm not sure if you have more fans or trolls. You have a lot of both. You have a lot of there's a lot of really miserable people. I am wanting to put out there that anyone out there that wants to ever get on and have a debate, I'm going to start opening up the floor to having an occasional technical debate with my favorite Twitter trolls. But you're going to have to come out and admit who you are, because if you're hiding behind an avatar, or my newest word for you, avatared, if you're hiding behind your avatar, I can't debate you, because it's really awesome to be tough when you are anonymous. It's pretty sweet. Right? Back to the, I'm old enough to remember AOL, like bullying on AOL or being bullied. So, I'm that old.
Well, let's get back to the equity market.
Oh, come on. I was having fun with that.
Let's go back with SoFi, though. I think SoFi might be somewhat of a not pre-read, but a tell on like why the market's pulling back so aggressively this week, especially with growth names and risk on. And I do think it's the Fed. I think the repricing of the December rate cuts is what's unwinding this week, especially when we got the commentary on the CPI data might not be released. That's obviously I think there was a sign that there's going to be less macro data available before the Fed meet in December. And that's obviously going to cause Powell not to be on the more aggressive side, because that's his style has always been not backwards looking, but past the obvious of when he should be doing something. So if there's less macro data, he's probably going to sit on the sidelines for one more month. And I think that's what the repricing is, where I want to say a month ago, the December rate cuts were supposed to be a 90+%. Last time I checked, it's a coin flip. I think that's what's happening this week. And SoFi is a great tell. And had an incredible earnings report. It was one of the strongest relative strength names before this week on just grinding up to the right, and now I think it's down 15%.
Well, you have to remember though. I mean, it went like 27 to 32 in 1 week. It was still
it was justified though. It was very justified.
I get it, but then it also ground back. It does look overwhelmingly like it has an S&P inclusion in its future. Mm-hmm. Its growth is incredible. It launched its crypto offering this week, which gave it more momentum. But at the same time, things appreciate at a certain pace, and you do have to sort of have this understanding. I mean, look, I think one of the things to talk about, at least I want to start talking about, is there is an issue right now that comes with the instantaneous alpha that a lot of people are getting. Meaning that, we can look at AI utilities, we can look at semiconductor names, you can look at growth names, and people have made incredible amounts. And parabolic moves have come with, in some cases, very little to justify them. In some cases, no earnings. Some cases, no revenue. In some cases, all a thesis or a theory on a certain industry. And then you have good companies that went up, but still are trading at incredibly high multiples. And what does happen is when you get kind of economic uncertainty, is you see multiples contract. You see some money get taken off the table. There were some technical reasons this week. There was a lot of pullbacks. One is funds. A lot of fund managers were closing out P&Ls. I've talked to a number of people on the buy side that said the funds were actually looking at the gains for the year. They looked at the situation with rates. They looked at the shutdown data, the possible lower GDP numbers. They came out of a good earnings season with some negative momentum and basically said, okay, time to close the P&L for the year. Normally that might go a little further into the year. Usually it's later that this happens. But one of the things I actually heard that this morning, but I think it was from UBS, they actually said it now, there's more money on the sidelines. Like, so actually now a lot more cash came down on the sidelines. And if we get a momentum shift, you might actually see another rally come back here. But like this whole always up into the right thing is really problematic. You know, it creates a lot of mental dissonance. It creates a lot of unhealthy, sort of relationships that people have. People tend to be very much believe that the money they've made on the up without selling is money they've made, but on the down, you know, they still haven't sold it. They look at it as intrinsically money they've lost. Whereas the same, like, you know, I have a lot of people coming up to me like right now on all the AI utilities. I mean, look, I'm in Cypher at like $12 or $13, somewhere in between that on average. I'm in, Wolf at about 12. And what I'm saying is like, those are two of my larger positions there. And I'm down a little bit now, or up a little on one, down a little on the other, but I'm down, way down from the high. You know what I mean? Like way down. I mean, 50% from the high. But that was never money that I've never taken that money off the table. So it was never really money you made. It was unrealized P&L gains on your account. Until you sell that stuff, you've never made it. But I tweeted something earlier this week, Shine. I think it's a good, maybe, good reflection. And I basically said, like, if you're trading hours, minutes, days, and weeks, you know, if that's like an investment to you, that's not an investment. That's trading. That's gambling. That is not, an investment. If you're basically buying momentum on a bunch of hype that you're seeing on X, you know, my average holding is usually somewhere between like 4 and 10 years that I buy stocks and hold them, you know, and it's like, so I get excited when they're going up. Of course, everybody loves to watch the account size grow, but like, I don't buy things to flip it. I never flip it. And I think I've shared quite a few times, like my trade is when things get mispriced, I use options to either get longer or to hedge. Meaning that, like, if I think that something's gotten super mispriced, I'll sell puts or sell put spreads well below the money into the future. I'll do call spreads into the future. But I don't sell the common positions that I hold in companies that I believe in. Very rarely. I've exited one position this year, and that was DraftKings. And I genuinely exited that position at about $50. I'd held it for 4 years, and it was because my thesis had changed because of the betting markets, that I believed that poly markets and Kalshi and these new Robinhood markets that were doing the betting had changed fundamentally where degeneracy was going to go, and it moved away from DraftKings into that. So like, that's the only position I've exited. Everything else, my horizon is still multiple years. Like AI utility names, I'm going to hold. I mean, unless something materially changes, I'm going to hold Cypher for the next decade. I don't see, at least 5 years, because I think the AI build out's at least 5 years, like before we're going to see demand and supply start to find equilibrium.
Yeah, I mean, I think you're highlighting a lot on what happens on an ugly, like when we have a couple ugly days back to back to back, and selling is very wide, it's aggressive, and it's happening to every name. It's not just a specific sector in growth land. Like, everything in growth is all just tanking all at once. And I think when the tape looks like this, the first thing that gets tested isn't all the weeks, months, years of research you've done. It's just the psychology, your headspace. Because when you see, because it's a lot easier to believe in your thesis when everything is green. Like, it's been the past 2 or 3 years, past 2 years especially, the market's been V-shaping. It's been up to the right. So if you believed in a specific theme, it was kind of easy to maintain that conviction because of that binary result in your holdings was showing that you were green. It's a lot harder when everything, every name on your screen is red at the same time. And it's part of the cycle when there's a lot of FUD. You're seeing a lot of headlines on the Burry 2.0 short. People start believing all the bear FUD because they look at the brokerage balance and they're seeing it is red. And usually that's when the worst decisions get made because you become impulsive. But it's really important to like really factor in the psychology behind what it's like to be a growth investor. And at the end of the day, it just comes back down to, like, do you have the conviction? Did you do the work yourself when you enter these positions, or was it borrowed conviction? I think the biggest tell on this day and age is borrowed conviction. A lot of people hear you, myself, just talking about these themes all the time, and they don't do the work themselves. So they get shaken out of these positions when they do go through a correction. Like right now, you mentioned Cypher. Cypher feels like it's tanking 40% in a matter of like 2 weeks. It's still look back 1 or 2 months ago,
Yeah.
it's like above 25-30% of what the levels are. So it's like not that massive. It just ran up a ton. And I
Yeah,
think that
but it might go down. It might go down farther. I mean, the
it
thing
might.
is like there's a very realistic chance that this selling is not done. And like today, we're going to find out. And we've got a lot of low volume stuff happening in the pre-market now. In 20 minutes, we're going to see how that happens when the market opens up. If this is a continuation, but I mean, I think the point is, and I think this is important for us because, like, look, we're a research firm. We do equities research and we do industry market technology research. And you are, you are so out there and willing to share your positions in detail. I share some of my positions and I don't share in detail. I'm not comfortable necessarily putting all my financial positions out there to people, but I'll tell you where my entry points are and I'll tell you what my, convictions are. And again, if you don't trust someone that doesn't share their entire P&L and doesn't share every trade they make, then don't follow me or do anything I say, because I'm not giving advice anyway. I'm just talking about what I'm doing. But the net of it is that like everybody's situation is unique. And it's a good day to sort of have that reflection. Like, you said about borrowed conviction. I think that's a good word. You talk about like, look, you want to run into a name because Mike Alfred's in a name. Well, Mike's financial situation is probably different than yours. And what I'm saying is his ability though, to say like, look, I'm going to keep buying and buying and buying and buying the dip. What I will tell you though, is in my experience is when you have conviction in a name and you keep buying on the way down, you do get rewarded. You do eventually get rewarded, and you will have to suffer for a period of time. You will have to suffer when everybody tells you that you're stupid. Okay. I mean, I bought Solana from 250 when the first time it got there all the way down to 11, and I bought it at 11 all the way back up. And I've been buying it every week. There's just a for instance, same with Ethereum. I did the same thing from Ethereum at 4,000 all the way back to under 1,000, all the way back to over 4,000. And I'm just buying it. And those are just two examples of things I believe in. Conviction. SoFi, same thing. Bought it in the 20s, bought it in the teens, bought it at 10, bought it at 5, and amassed most of my position under $10. Most of my positions under 10, and my average is around 8. And so my point is that like I listened for 5 years to people go on the charts and tell you every time after earnings and after SoFi would get crushed after every report and say, you're stupid. You should get out of this. You're getting rich, dude. You're an idiot. And by the way, over 4 years, you got a multi-100% return on a name, even now after this violent selling. And what I'm saying is people will come out of the woodwork to tell you you're stupid. But again, if you can't absorb that loss in philosophical money loss while it's going down, if that money is you need to pay your rent or you got to pay your cars, or you got to buy your freaking kids formula, then yes, you are gambling. You are gambling, and you need to really, have your head examined. But if you are investing and you are looking, and like I said, I look at my portfolio more than 10 times a day, partially because of what we do and partially just because it's addictive. But I look at it every day when it's gone way up and it's way down, and nothing changes because I have no intent of selling these positions. I have no intent. I just think it's important that people kind of, even the people that listen to us and talk to us, like, I think it's important that they take all this into consideration, Shay, because when you say things, people act, but it's got to be their own research, their own conviction. You're giving them something to start with, which is what your thesis is. But you're not saying anyway. I've never seen you say you should buy this. I think it was Mike that actually said that. Unless you gave me your logins and I went into your account and bought, I didn't tell anybody to buy anything. Like,
it's really funny.
Don't blame others. And by the way, like, don't give the same credit when it goes up. Like, I don't, people are like, I bought this because, and I always reply to them. I try to reply, when I see the comments, I'm like, don't do it because of me. Like, I'm glad you found it and you did your research and you made a decision, but like, don't buy it because of me. Like, don't do what I do. We're not mimicking each other here.
No, it's funny. A lot of like what you were saying just made me feel a little nostalgic because there was a period where I was buying pounds here nonstop when it dropped from $14 to $8, and everyone kept saying that I didn't know what I was doing. Black box consultant, it's malware, it's a fraud, blah blah blah. Same thing with Rocket Lab. Like when I was buying it from $7 nonstop to $4, people were like, it's a launching company I would never do well against SpaceX. Why are you wasting your money? Like these things happen all the time. Right now, I've been buying hand over fist a lot of data center names. Mainly because we've done the work at Futurum, especially there's so much data that backs up the notion that the data center build out is not slowing down and companies will not be able to afford to delay capacity no matter what happens at the Fed. So knowing that, like, that is my North Star. like data center build out will not slow down. I think that eventually it might turn into a much bigger bubble. Who knows when? I think it's years away to even begin that conversation. But right now, not happening. The demand is too insatiable, like we always talk about. So knowing that's my North Star, I feel very comfortable adding to these the irons, the ciphers, the nebulouses, because I just don't think it's going to be anytime soon where it's going to start maturing. I think right now what's causing a little heartburn was the financial maneuvering on how to get these data centers funded. It's very unique, it's very real, it's very new, and humans react to wonky ideas in a very aggressive way at times, and they spotlight this little hole on this whole thesis when you should just focus on the whole thesis. The AI is structurally going to change the world permanently for decades, not just years, decades, permanently. That's all that matters.
Which, by the way, though, it's interesting because you remember when Zuck did the metaverse and he went all in on investment, and the sentiment totally changed because Reality Labs was burning cash, and all he had to do was tweak the business ever so slightly and go away from the burn, increase, got back to kind of focusing on costs, increasing revenues, and driving outcomes. And like instantaneously, that thing ran. Like look back to Reality Labs, the dip, and then the comeback. So if you actually look at that whole situation, right, and you say, okay, similar thing going on here, like what the thesis is, and I'm fortunate enough to spend time with a lot of these CEOs, is that they don't want to be caught underinvesting. Okay, if you want to see the example of the damage of underinvesting in the near term in AI, just look at AWS, look at Amazon. Now, Amazon's had some better months lately, but if you actually look at how much it trailed Google and Microsoft and others, it was because in the beginning phase, it underinvested in NVIDIA. It did not have enough capacity, and it actually only bought at the same levels. They were buying NVIDIA at the same levels as like Google and Microsoft, but the problem is they were much bigger, and they had a much bigger customer base to serve. And what happened is they couldn't serve the customers. And so not only did that cost Adam Selipsky his job as the CEO of AWS, but it also caused AWS's acceleration to come down considerably, and it gave Azure the chance to catch up. It opened doors for Oracle. It created a good growth opportunity for Google. And now what is Amazon doing? They're investing to catch up. Now they're spending more CapEx. People are like, oh, should they spend more on CapEx? But the thing is like the alternative is way more risky. And I know right now when people are like a little bit in the panicking mode is like, oh, I don't want you spending CapEx. Oh, I don't want you to raise debt. That, by the way, is oversubscribed by 6, 12, 20 times. Like people want to buy this debt. They want access to Meta's debt. Because they know these companies they're cash machines. Meta is a cash machine. Google is a cash machine. Oracle, that one's a little risky. They're not putting off as much cash. OpenAI, of course, that's risky. But I think I've said on TV, like no less shy than 10 times now, is that like there is literally a bid for any price that OpenAI comes at. And when you heard Sam get super defensive on the podcast, the BG podcast, about like, because his whole point is like, fine, sell your shares. There's a buyer. Like, you don't want to be in, you don't like this, you think it's too risky. There are plenty of people happy to come in at 250, 500 billion, likely $1 trillion. If this thing goes public, I mean, look how many people, and you're one of them, that will invest in space companies that may not have revenue for half a decade. OpenAI has revenue accelerating at an incredible rate. Now they have incredibly high cash burn, but they can raise the cash. So yes, is Masa crazy to try to get a bigger return on OpenAI than NVIDIA? Well, maybe. I mean, the answer is really maybe, because is NVIDIA going to go to 20 trillion on market cap? Because there's a very realistic chance that what he's in on OpenAI at 200 bill or wherever he exactly came in will 5x from here. So people are even doing the wrong math on that, because the bottom line is, yes, if you're a long-term passive investor, of course NVIDIA is a better bet than OpenAI. But if you're a shorter-term active investor with a company that actively invests in operating companies like a Berkshire or like a SoftBank, you need to look for higher levels of return opportunity. So, people need to actually kind of pay attention and think about these things holistically. But Shai, the AI, nothing's changed. I mean, there's not a single person I've talked to since yesterday, all the way since yesterday when the market changed, that was like, AI's done. It's over. We're not going to do it anymore. We're going back. We're going to get pencils out. We're getting paper. We're shutting down the data center. But one other thing I will say is like the depreciation thing is a real conversation. Like the CoreWeave has some real work to do on that 6-year depreciation. They're also levering up against there is something there. Like, so I guess the moral of that story is there can be pockets that are bubbles inside of a trend or a super cycle that isn't necessarily constitute that the entire thing is a bubble. And that's where I think a lot of people are messing up is there's a super cycle going on, and inside of it, there are bubbles forming, but they are small bubbles and isolated.
So I actually do think the neoclouds, like there's so many of them. People just think there's only a handful. There's like dozens of neoclouds. I do think that is the telecoms of the .com era. That's what the AI era is going to be. There's going to be a decent amount of them that will just not be able to figure out the depreciation like you called out, that are just capitalizing on the moment. And eventually as compute becomes a commodity, because there's going to be a supply and demand is going to start evening out, you're going to see a lot of these high valuations start not tanking, maybe tanking, just because they were just raising at a really specific moment that is going to be temporary. Because spoiler alert, even though demand's going to continue going up and up and up, supply is eventually going to catch up. That's just the way it's going to go. At this rate, a lot of these neoclouds are just catching insane bids. I'm not talking the Nebuses, Iron Ciphers. I'm talking about a lot of the tier 3 ones that are just like all of a sudden trying to catch this AI boats, and they're going to probably get ridiculous valuations. And now that to me feels like where the valuation is going to really exceed. We've been very adamant that there's pockets in AI. Like I'm Palantir, top position for mine, spin. I sold like an idiot. I sold all my risk in the 60s and 70s. So the rest I have, it's in profits, but still my top 3 position. I wouldn't touch that with a freaking pull, like a 10-foot pull, when it's at trading 100 times free cash flow at 500 billion. I think it's going to be $1 trillion company before the cycle is over. But if you don't have any exposure in it, that's not where you should put your new capital in. And I think for Meta, let's go back to the Meta example, because I went on BBC just recently to talk about it. If you're a Meta shareholder, they produce $70 billion in cash a year. What do you want them to do with that cash? Go with cute little short-sighted buybacks, dividends, buybacks. Yeah, just not
right into obsolescence, right? Right into obsolescence.
It's ridiculous. We're in an arms race.
Xerox.
We're in an arms race right now. Like, just think about we're in war right now, and you just want them to focus on watering the garden at the control center instead of getting the ammunition to win the war. That's what it's like right now with the mentality of these value investors versus if you zoom out, think about where the world's heading. We're in an arms race. And not just that, it is a really unique time where we have super cycles colliding. AI, space, quantum, electrification, all these super cycles are colliding with an administration that will not allow the US to fall behind in any of these races, because we can't afford to, because the world is going to change in the coming decades due to this massive tech revolution we're experiencing right now that's never happened in mankind history, where things are going, the efficiency boom is going to be bonkers. And now the characteristic of the world is going to change. So in order for the US to maintain their dominance, they need to stay ahead of it. So I think the US, as they should, treats AI as an economic power and national security lens, while enterprises, which we talk about all the time, are treating it like an arms race. So when you have those two things colliding and both are pushing the same direction, like I just don't understand how you can be bearish besides just seeing the market pull back.
There is like a very realistic, reason to believe things are mispriced, some things are overpriced, and being able to spot that is a skill. I just always say there's more opportunities, in my opinion, to be long great companies and not be the jerk at the table playing the don't pass line. But look, X is a cesspool of like the world's most emotionally insecure and unhappy and miserable people. And so I think those are the shorts. I mean, all joking aside, there's some really intelligent shorts. But, the other thing too is like positioning. I think you said something that's really important is, and I notice a lot of people that criticize you will call you out, and they do this to me too, on a pullback on a position that you're up like Palantir, like a position like you're up like I'm with Robinhood, or, they'll say something. I was, kind of interacting with someone about your quantum thesis, right? And like, I don't remember, but aren't you NINQ at like $10 or something like that?
$7.
Yeah. So the point is like when it was at 80 or even at 40, you're not buying, you're not adding to your position right now. But at 7, you're willing to ride on a potential of a company and an industry that could be monumental in terms of protecting stable coins and cryptocurrency. A company that could or a industry that could, innovate with AI meaningfully to solve, problems that exist in physics and in the real world. And my point is like, they're all like, well, you're down a lot. Well, you're actually up a lot. You're down from where you were at the peak. And had you sold the top, yeah, you would have made more money. But, the point is you entered at a good price and you're sitting on it. And by the way, it might take 2 or 3 years for that narrative to have enough, or maybe more, by the way, but it might take a few years, especially for investors that actually want to see real revenues, profits, industry growth, TAMs, that understand the market, to say, look, yeah, now it's trading at that fair value. You could do the same thing with your space stocks. I mean, we know that space connectivity is a really important trend. You're invested in it now. These stocks have run incredibly far. These companies have no earnings. They just have a trend and a thesis that you've gotten behind and that you believe in, and you've bought into them. But most of them you bought in at much, much lower levels. And I think sometimes people need to hear you and say, I am not adding here. Like, I am not adding here. Because I think that's the same point. Like, you can invest very well, but you do have to deal with gyrations. And there is the ability to understand that sometimes things do run, they do get mispriced. I've always said about Palantir, and I'll leave my thought here, Shai, is that like with Palantir, for instance, it's like, I wouldn't get in front of that bus. I think I said that because, it just has too much momentum. There's too much support. It's got too much ability to make these parabolic moves ahead of maybe its earning an intrinsic value supporting that price. But like, there's other things I'd pick. It doesn't mean it's not the right short for you, but I don't want, I don't know if you saw the samurai sword in Alex, but I don't want to get in front of Alex Karp with a samurai sword. Like, I just think there's other things that aren't growing at rule of 114 that aren't profitable and aren't going to be the foundation of the future of enterprise AI. So I'll pick something else, but it doesn't mean your play is bad. It's just not my play.
No, I mean, I think going back on cost basis, if what you're referencing, I think people really do underestimate the flexibility of getting into a name very early and maintain that ride, and how you go about that for that whole journey. Like going on Palantir, Rock Lab, IonQ. Like, I talk about these names all the time. I haven't had Palantir, IonQ in years. I think Rock Lab, I think, is a different story. I've been dipping my toes a bit, but I probably have added 5% of my Rock Lab position this year. Like, it's very different. The cost basis, how much flexibility it provides, because when you get in early before the FOMO kicks in, it's one of the best feelings in the world, actually, where you could just like see everyone validate your thesis because you were first early, and now everyone experienced the FOMO premium, and you just sit back and relax. Right now, what names have been adding on this macro dip? I've been building up my AI utility names, but like most of my funds, almost all my funds, aren't going for these speculative growth names at all. I'm not buying this dip on those names because I think the risk and reward really still isn't there right now. And I have good positions already in these themes that early on that I'm okay with where I'm at now. I've been adding to Meta. I think Meta is a totally different, big misread by the market. And I think that Brody's 2.0 short helped kind of punish them a bit. Same with the oracles. But I don't think the distribution that Meta has is unmatched. And I think that the new digital economy is going to start being priced on eyeballs and distribution a lot more than the old economy. And everyone still views Meta as this like social media platform, but they're an engagement platform wrapped around the amount of compute that they're building up is going to be bonkers. And I think that that's the name where they're trading at under 20 times earnings. I think their PEG ratio is very expensive just because of that margin compression that they're experiencing due to all these investments. But like I mentioned earlier, what do you want them to do with that $70 billion in cash they produce every year incrementally? I want them to invest in what the world is turning into, the new AI economy. So I will gladly keep adding around these levels, knowing that maybe it doesn't go up for a year from now, and I'll just continue building it up because this is, in my opinion, going to be $1,000 stock one day. I really do believe that. I think that the earnings power compounding machine that they're going to be able to pull, and all the levers that they have across how many eyeballs they actually own is going to be ridiculous, especially when the tokenization is going it's going to become a lot more affordable due to all the compute that you're going to get. So I think that Meta's another name. Another one is Mercado Libre. Like I think these are very different names, and a lot of people probably think I would be adding in because of what I post on Twitter, or like I'm a speculative growth investor, but I haven't been a speculative growth investor in years because they've all ran up a significant amount. Now it's just I'm adding to names that actually produce cash and earnings, and their PG ratios very different.
I did most of my growth positioning in 22 and 23.
Yeah.
Like most of my buying into growth was in 22 and 23. Like and by the way, I wrote some things down like 80%. So I've been through this. Like this is not, but like again, the emotional ability to be an investor just isn't for everybody. It's a toughie. Like I said, one bad day and like literally everybody's losing their freaking minds. I still recommend for a lot of people zoom out. I mean, in cases where you did buy the top, and I think we've all done it before, where we just think something's going to run and you take a flyer. I can say it's been very rare in my case because very rarely do I jump into a trend late. I'm generally trying to trend spot like what's going to happen. I called NVIDIA in 2022. I was on CNBC Squawk Box in 2022 at a split adjusted cost of $5, arguing with Becky Quick, I believe it was in that interview, that NVIDIA would be the most important stock in AI. The interview's out there. You can look it up. We called it out, early, and these are the kinds of things that you see before they happen, and you get in position into these industries early. We were banging the Avago drum 50% ago or more that it would be the most important for custom AI chips. We were banging the Micron that the HBM was going to be rate limited. Every part of the AI supply chain right now is supply constrained. There's not a single thing where there's enough supply to meet demand. So right now, all we have, if you want to be the most bearish, is a couple of chatbots that create funny videos and create, language models and maybe do some coding. And right now, we literally don't have enough compute to support the demand for those, period. And so when all this enterprise stuff starts to actually take off at scale, and it will, because enterprises are going to use it to gain EPS, and people don't like it, but it's going to augment jobs, and eventually it's going to displace a lot of jobs. My biggest concern about the economy is what actually happens to people when these people that, these emotionally unstable people, but also just some unfortunate people don't have jobs anymore because literally the robot's willing to work 24/7 and, punch numbers into spreadsheets and write press releases and do all the work and the jobs. Like that actually has a concern to me. Like, I don't know what happens when Amazon's, plan to get 75% of its jobs automated with robots, autonomous delivery trucks, drones taking stuff to your door. That to me is an actual real economic problem that we need to think about a little bit more. But the build out of AI, and by the way, I was with Lisa Su this week at AMD's Financial Analyst Day. And, I've had the benefit of talking to her over time. And I think she's one of the most disciplined, very realistic CEOs on the planet. And she doesn't overhype. She's never oversold. Has done a tremendous job building that company's growth. They were a $4 billion, I think, of income, like $4 billion company, I believe, like 10 years ago. You just think about that. And look at where they're at now. But basically, they've upgraded every part of their forecast, upgraded their margin forecast, they've upgraded their revenue forecast. They basically called the TAM for data center infrastructure at 2030 $1 trillion. She raised that number from 300 to 400 to 500 to $1 trillion is the TAM that they see accessible to them by the end of the decade. Jensen Huang, $500 billion in the next 14 months in the order book. We see a $300 billion at $150 billion net income. Their forward PE is actually going to come down. The forward PE of NVIDIA is coming down mightily at a growth rate like they're having. So, people as a whole can, like I said, we can feel things are overvalued and we can appreciate a correction. And by the way, when everybody says, I wish I bought more at X price, I mean, what are you doing right now? I don't know. Like, what are you doing right now? How are you positioning? Because it sure seems to me like it's a lot of panic. But, you said, oh, I wish I'd gotten more Robinhood when it was 100 or 120 and not waited till it was 150. Or I wish I'd bought more, like in SoFi at 25 before it already ran to 30, 32 or 3 or whatever it did. It's like, well, here it is. It's back. What are you doing? So, there's a lot of that out there that's like, are y'all talk or, is it just one of those things that, like I said, we're all gambling. It's all gambling, And that's why I said, like, I can sleep at night. I'm actually, like I said, having quite a bit of fun with some of the trolls right now, sharing their great posts. I've been amplifying you. I appreciate those of you that have been logging into my accounts and looking at my positions. But like, it's been one day. And most of the positions I have are up like, 30, 40, 50%. I have gotten crushed from the top on the AI utility names that I bet on. But my theory on AI and energy hasn't changed. So, some of these I'm going to watch, some of them I might add to here. Some of them I might just let play out over time because I did get pretty heavily positioned. But by the way, most of these I'm either still up or I'm right around flat. So I haven't and by the way, I've, I don't know about you, but in 22, I literally have positions drop 80%, Shy. Yeah. 80%. And I was getting, because I don't trade on a lot of margin, but I have margin. I mean, I was getting calls like, you have to send money in like 3, 4, 5 days in a row. But again, that is part of this process. Otherwise just buy an index, buy an index and just hold it. You can get your 10%, and over the next 20 years, you'll do fine. At 10% a year, you'll almost beat inflation.
So I think you mentioned a really good, interesting point as well, where some people aren't made to hold specific holdings. Like, that's totally fine. Like, I really do believe that a lot of investors have gone overly confident over the years because of the up to the right environments that we've experienced. And every dip opportunity has been an opportunity, V-shape. I still believe this dip, like, it depends on where we close today, because I think the market looks like it's...
By the way, we're open. What happened?
That's what I'm saying. I think we're catching somewhat of a bid. It's too early to tell.
I mean, is it like way down or...
Oh my God. Rock Lab is green though. So that's interesting. I added to that this morning when it was down 8%. What was I going to say about this?
But it was a little bit of fuckery in the pre-market. I mean, things were just getting rinsed in the pre-market. Low volume.
Yeah, liquidity is the
reason. I get that word in here. I wanted to make sure our YouTube has a explicit. Do you think it'll pick up the word fuckery? Like, is that
well, what I was going about it before. I do want to talk about the markets after this. What I was about to say, but it's totally okay. Like, if you're not built for volatility, I think.
Yeah, I'm not judging.
If the last couple of weeks have really made you lose sleep, again, Dano and I sleep very easily at nighttime because we know what we own and we can handle. We have the stomach for it. But if you don't, and there's zero shame in realizing that the past couple of years you've outperformed the market if you followed a lot of these growth stocks, these growth themes, and now it's become too difficult to manage. It's become too much of your portfolio has increased as significant part of your total net worth now, where you can't afford to maybe experience a 40% drawdown or 50%. You're not in a position like myself or Daniel where we can maybe capitalize on volatility, and what we invest in right now, we don't need next month to pay for specific bills. That's a big different mentality on how different investors everyone is, but it's totally fine for you to just cash out on these names if you want and buy an ETF if it's too volatile, because things will potentially get worse. You don't know. We don't know what 2026 will be like. We don't know if the AI build out is going to create a lot more FUD due to the depreciation on the compute and all the financial engineering. We don't know if actually I have a pretty confident idea that Jensen is going to deliver next week, but we don't know what the market reaction will be towards those.
Yeah, we'll finish the show. We'll talk about that at the end.
Yeah. So, but that's actually a good. Let's go over the markets right now and see what's happening. All right, I'm seeing stability. SPY's down 1%. QQQ is down 1.2%. Rock Lab is up 1%. Interesting that I'm seeing IonQ is about to go green as well.
Hims just went green.
Hims just went green. IWM is outperforming big tech right now. So it's yeah, it looks like it's getting bought up. Let's go on the S&P 500 where we're at the 8-week EMA. That level is at 666. Wow, we're right at that level right now.
Devil.
So
the devil's in the detail.
That is crazy. We're sitting right there. So if everyone wants to know, my hedging, I do hedge. A lot of people think I don't hedge because I'm just full on bull. I think it's really important to have an investor hat and a technical hat. Like you need to have both. 90+%. I don't sell my long-term holdings to if I think the market is going to lower, but I do capitalize on the downside via hedges.
What do you do? Tell me.
I buy typically it depends on the VIX. Let me see what the VIX is right now. Actually,
you buy puts?
I buy puts on the SPY and QQQ for 3-month out usually. VIX is at 22, so it's a little elevated contract. So I want to see where we close on the weekly. But if we close below that 666 level, I will buy some March puts probably on SPY. I mean on QQQ. And the level I will look at though is seeing where the 200-day moving average is on the Qs. So QQQ 200-day moving average is at, wow, we are a ways to go still on that. It's at 542. So if we break through this level and we stay below the 8-week EMA, I probably will buy some 550 strikes on Qs expiring in March is how I would handle it. And it'll probably be around a 3% position in my portfolio. And why only 3%? If I'm wrong, I lose 3%. Guess what? I'm up so much more than that on the year. So I'm willing to sacrifice some of my year-to-date gains to protect my portfolio because like what Daniel said earlier, he was down 80% on some positions. I was down similar in those positions on the drawdown. I don't think this is at all a similar type of pullback. The previous one was a bubble formed from the Fed. It was very much a macro event. This, everyone's poking holes on how these hyperscalers are spending their cash flow. It's not borrowed money. It's literally money they're printing. It's totally different. It's just they're poking holes.
Well, some are borrowing some money. I mean, some are,
but the most of it though is based on cash flow.
But these companies can afford to invest. That's the bottom line. They can afford to invest and take the risk. And the type of growth that the market expects from these companies has to come from being able to support the secular trends. And this is the secular trend. It's AI. This is the trend that will enable these companies. And by the way, when they get these things built and deployed, they will actually be able to cut OpEx materially. They already are, but they'll be able to cut OpEx more, which is another important thing to note. Now, just to share a little bit of perspective, like I don't generally take any short positions ever of any type, including hedging that way. What I do is I do trade long dated outside the money options that allow me to get longer, but collect premiums and basically give me the opportunity to buy into things that I believe in at much lower prices. So most of the time I put them so far out and I put them at such a far price from strike that I've almost very rarely in my entire career have I ever been, or in my entire period of ever holding, have I ever seen a meaningful impact. This could go wrong. If you had like a Liberation Day kind of thing where you just have that kind of volatility, it could. But like I'll give you for instance, like you remember when Viking after phase 2 had that huge pull down, right? It went from like 44 down to 24. I sold like spreads at like 15.10, like a year out. And I collected nice premiums on 15.10 put spreads, like 50 cents, 60 cents a share kind of on those days, on that high vol day. And by the way, when it went back to 40 this week, I closed all those puts out at almost 99% profit on the actual original. I kept 99% of the money. And I closed them out, I closed out like $47,000 of income on those spreads. And, the same thing now that's gone to 40, I've been setting 30-20 spreads and collecting like 250 a share. And then basically those things diminish over time when the thing rides up. When it goes back down, I start trading 2015s again. And so like I'll trade those things way outside the money. I collect the premiums. And like I said, there is a risk of getting the contracts assigned. I did have that happen with SoFi when the markets really dropped, where I actually probably collected about 20% of my position because I had puts assigned to me that I sold. But like that's something I do. The other thing I like to do is when vol drops is you buy one side of a call spread. So when it drops a lot, the calls get cheaper, and then when it rises up, the other side of the call gets more expensive, and you can offset your spreads. So, for instance, like when I did the same thing with Viking, when it drops a lot, you can buy calls for I bought 2027 January calls at 70, really cheaply. And then when it rises back up, you look and you sell the 120 on those positions. So you buy and sell the 120, and you have a very small amount of spread to have that $50 earnings opportunity. Because I believe this company is going to get sold, and I actually don't think the macro means anything to what's going to happen with that company. So it's that's a great company to position. And another thing I've done, by the way, is, and you'll laugh at me, I think I told everybody, is I bought Pfizer. So another thing I do is I rotate out of growth, and I will take positions in high yield, high performing, consistent companies that do well in more tougher macro cycles, like healthcare. So, I bought a bunch of Pfizer when I, started to see a little bit of rotation. I took 20% of the cash I raised from DraftKings, and I just put it all in Pfizer, and I'm just let it sit there. Because like I said, Pfizer won't move more than $1 or $2, but it's paying almost 7%, 6% and some odd change in yield right now. And Pfizer's not going to, it might drop to 20. It's at 24. It just doesn't have much room. It's trading at book value right now. It's trading at book value. I mean, and so there's always those kinds of plays too.
So
anyway, that's a lot there. That's a lot to digest, but that's the playbook.
No, sorry, my headphones made that weird noise. I was like, oh my God, is it dead now or is it dying soon? So it made that noise, guys. So we'll see in the next couple of minutes. But before we wrap up, I do want to talk about Super Bowl of earnings next week.
SoFi just went green.
There you go.
It was down to 70 in the pre-market.
See,
I'm not saying it'll end green. I'm just saying.
No, but I'm just saying it's getting scooped up though, and again, the market is catching a bit above that 8-week EMA level.
Fuckery.
But I'll give my 2 cents about my expectation. NVIDIA before I hand off to you in case my headphones die. But
you don't have a speaker in your office that you could change over to if you had to?
No, I need to figure that out.
Jesus.
I know I'm amateur level.
Take some of those profits that you've taken down and buy yourself a freaking speaker.
I know I should, but for NVIDIA, I think again, NVIDIA is never about the actual fundamentals. I think it's the past couple of earnings for NVIDIA hasn't been really about their fundamentals. I think this most recent one is again it's less about the fundamentals and more about the exhaustion that we're seeing at the top right now for this AI bubble, AI economy, AI trade, AI cycle, whatever it might be. And I think that Michael Burry's puts against NVIDIA and Palantir probably spotlighted that worry. It's been treated as a referendum on the AI boom itself, but I do think his bets were more tactical, not existential on AI is never going to materialize. It's going to be. I think his hedge was just specifically on something totally different, like grid capital, over valuations and grid scarcity, not really AI is that. Anyway, going back in NVIDIA, my 2 cents on it is I don't think the headline numbers alone is going to tell you anything that will move the market on the stock price or the stock price. I think the context behind it will matter even more. The first, again, is how NVIDIA will manage the revenue mix between their Hopper shipments and their early Blackwell ramp. And what I've been reading, it's pretty dominant on the Blackwell side. I think that the data center segment is going to have to outpace the midpoint of guidance by a wide margin, especially when you've seen the stock at $200 and it's ran up a bit entering this print. So that guidance is going to matter a lot. And I think the question about it is going to matter even more. Is this more accelerated deliveries that should have landed next quarter but landed now, or is it actually generally new demand that's coming online through their NVL 72 rack shipments and their new products that they release? I think it's more the latter. So I do think that distinction will set the tone. And also the third one is going to be gross margins. I think the gross margin composition is going to be important. I want to say they're guiding to 74% margins, but it really matters how they get there. I think it's going to be mattering. Is it their product mix or is it pricing discipline? And also it's a good pre-read on whether the incremental competition from AMD's MI450 series or the hyperscalers custom silicon chips is going to start pressuring pricing. So that's what the NVIDIA.
We're not going to see that yet because that's a second half next year product from AMD. Just, for everyone out there, like we may not get that level. I actually think there's two things happening though, Shai, that's important for people. I think there's one thing that's going to be, is the AI trade intact? Like this is the most clear symbol for the market that wants to understand, is it intact? Meaning, is the everything they're building still being sold? Are they still totally in control of price? What's their forecast look like? Meaning, do they see this continuing? I think the China scare is over, not because they're shipping to China, but because they can't build enough to support China anyway right now. So they've just rotated that out for now. At some point, that will impact growth, assuming we get to a demand-supply equilibrium, which again, most of the data we have says that won't happen for at least another 4 years at best. And again, by the way, if we looked back 2 years ago to what we were forecasting, we weren't even close to understanding the amount of demand. So we're still kind of making decisions on what could happen 4 years out from now based on what we know today. Which, just imagine in like 2 years when all this stuff starts to actually really work and be implemented. And by the way, not forget about just data centers. Think about physical AI, edge AI, autonomy, and vehicles, and all the other things that are going to take compute demand, like at huge scale. Like when you hear about Elon Musk wanting to build his own silicon supply chain, it's because he knows that if he wants to be 8.5 trillion and get his $1 trillion pay package, he's going to need to actually control his supply chain, and he can't get enough wafers from TSMC. So just a little sidebar there, but NVIDIA is going to do the business. Like, the last quarter, if you remember, the data center number was a little bit tight, and I think some of that just has to do with production. But everything like Quanta and all the different ODMs have basically said like the ramp has been incredibly fast. The supply is heavily constrained. They're selling and building for everything they can get out there. There's very little reason to believe. I will say this though, in my most bearish comment I will make, if NVIDIA does miss, it is going to be a meltdown. The market would absolutely capitulate. Like you thought yesterday was bad. Like if you want to, if someone wanted to take like a really low cost but high side risk is buying puts like into the print, because like they're probably not crazy expensive at some level, but like if like I'm not even saying NVIDIA puts, I'm saying like QQQ or anything, like because like if they miss, you will see like a massive sell-off, in my opinion. Like that will be the sign.
3 or 4% dip.
That will be the sign. And by the way, that's not counting like beta. So people have to remember, like beta. Like yesterday, you saw most of these growth stocks. Beta's like 6 to 8 on some of these names, and so all those things attached will go down like 20. That's like 20-25%. Having said that, like I don't think that's high probability, but again, that is the real reality. And by the way, I also think to what you said is like NVIDIA may not move much on the print. Remember, there's a company that's like cutting up to around 5 trillion in valuation. Like they're just at a point now where you're not going to see parabolic moves unless they absolutely blow numbers out of water. And unfortunately, the supply chain is too predictable now.
Yeah,
we kind of can count how much they can buy, build, and sell. So there's a whisper number and it is above the guide, but it's not going to be like those early quarters where it was like massively above, because there's not enough fabs. Can't build enough chips. Can't put enough racks together.
No.
So I'm still, like I said, AI wasn't canceled. My moral of the story here, there is uncertainty in the macro. The shutdown did matter. It's affecting GDP. The rate cut issue and maybe not having a rate cut is concerning some people. You do have hedge funds and investors closing out positions, taking gains for the year. A lot of them have done very well, and they want to close their P&Ls out. That does put money on the side. That does create some opportunities. But if your growth bet is on AI, you just have to realize that there's going to be some volatility. It doesn't mean that anything about the AI thesis has changed. It really at this point. And by the way, the one other thing to learn, and I hope you have learned, is that there are companies that are attached to this AI trade that are not good companies. Period. Got to do your research. You should look at depreciation. Michael Burry's a smart guy. He's a really, really, really smart guy. Like smarter than us, like 100%. Like just in case. I mean, I don't know if he's smarter than Sundar. I don't know if he's smarter than Jensen, but he's smarter than we are. But he also got his name from shorting housing, shorting a consumer trend, and shorting something that was heavily obvious, by the way, looking back in it. So right now, everybody thinks this is obvious. I think there was a Delivering Alpha event yesterday, and I heard a quote from it. But basically, people are confusing a super cycle for a bubble. And right now, it's a super cycle And inside of every super cycle, there are elements that look like bubbles.
Mm-hmm.
And I think that's what.
Well, I think this is going to turn into a bubble in pockets. I do agree with him. I just think it had. We only talk about the. I can add some brief color on some like not shit codes, but companies that are just riding the tailwinds of AI. Like let's talk AI utility theme, like specifically. Like I don't think CleanSpark is at all should be a player in that space. Like they just don't belong there. Another one for data, C3 AI. That's been a shitco. It's been an awful, awful company to buy. They are just counting, saying that AI is in their ticker and they're going to be capitalizing on like the Palantir of the world. But look at their stock price, and the CEO founder left. Like it's going to get sold off. I think software is not where you want to be. Like we've been very adamant about that, especially in the CRM space, especially in the DevOps space. Like you have to be very careful not to invest in layer type companies, like companies that will just be a layer into someone else's stack potentially. That's not where you want to invest during this kind of macro driven pullback. You want to invest in the companies that have the network effect, they have the moat on their ecosystem, they have sticky customer base that they're going to be able to scale through distribution, having that AI brain, just having all these moats, defensible moats that nobody else can really disrupt. That's where you want to capitalize on, not in the, I don't know, Monday.com is below 20 times free cash flow. That is freaking cheap. I agree with their growth fundamentals, but Dano and I both are not a fan of that space. We think that space is very Gen AI.
It's a feature. It's a feature that'll live inside of some AI platform.
But it could be a great trade in a year or two. We're talking 5+ years out. Same thing with a lot of other names in that space. Like just be careful where you invest in. We're not hyper bulls. We communicate. We talk about a lot about our bull thesis. We don't add too much FUD because there's plenty enough with the trolls on Twitter and elsewhere, like why it contributes. So I do think I think that right now we are going to have a good finish, it feels like today. Like I think that's right now Q's is 0.5% down. I'm seeing Stair Labs up 4%, Rock Lab up 4%, Ion Q's up 4%, Oculus green, SoFi's green, ASTS is Palantir green, NVIDIA green. This is
I had a friend yesterday, Shy, that their business is to basically advising the buy side. And they basically said that they were talking to a lot of buy side. They basically said this week there was a ton of closing P&L positions, which mean they went to cash, closed their books out for the year. And now they're basically on the side looking to get back in. So they basically, it was almost like, a coordinated, it wasn't truly coordinated, but it was just the algos took over coordination of the selling on all the different events. And, I mean, I think as a whole, by the way, Barry said something else that was smart, and then he didn't actually do it. At least I don't think it was, but he kind of said sometimes doing nothing. And sometimes in these kind of hyper gyrations and volatility, like, we talked a lot about what we do, but sometimes when you just believe in something and you're long-term, just do nothing. Like, you don't have to like try to catch the falling knife. You also don't have to buy every rip. Sometimes getting longer, like those are all things that you have to take into consideration. Like there's a lot of opportunity costs. There's a lot of different things. Like, some people poured in yesterday and they're going to feel smart right now as things are recovering, but we might have another downturn. And then you're like, oh, maybe I wasn't so smart. And there was a chance to buy even cheaper, and sometimes just patience. I think it's isn't it the Buffett or the Munger quote that's like investing is all about like moving money from the impatient to the patient.
Oh yeah. It's a voting machine. I think that's what it was.
But like the impatient to the patient thing to me is all like most of my best trades were when I got positioned and then did nothing. I just got positioned and then held them. Look at the things that you have that are up like 4 and 8x. You bought them 3 and 4 years ago, Shy.
Yeah.
You haven't done anything. You trimmed off. Maybe you took your principal off, right? And you're riding profits. And like, so what if it pulled back a little bit? Like, you're not pulling the money down to pay for your kids' college. And my God, your kids are not going to college. Not because they're not smart. By the time your kids are in the world, man, there won't be college because we'll just be getting trained by AI. We'll be working for the robots. So
yeah, real world college.
I got to run, but there's my thesis for the day. But in 20 years, we're all just going to be working for robots anyway.
All right, we're going to end on that note. Everyone, enjoy, touch some grass if you're stressed out today. I think we're closing off really strong. Relax this weekend because NVIDIA is reporting on Wednesday. And We'll see you then. See you next week, same time. I think we like this opening time. Thanks for the 20,000 people hopping in and watching, and stay safe out there. See you next week.